Welcome back to Investing Talk podcast. Today we're looking into a question many of you have asked about a pretty well-known name in the market, Tilray brands. Is it a good time to buy now? We've gathered some comprehensive insights, some source material to help you unpack this complex story. Before we jump right in, if you find this kind of detailed analysis helpful, please remember to subscribe, like, maybe leave a comment. Your engagement truly helps us bring you more of these focused discussions. And hey, if there's a specific company you'd like us to look into for a future session, just drop its name in the comments below. You can also consider buying us a coffee to support the show. We always appreciate that.
Yeah, it's a really fascinating company to examine, especially given, its diverse operations across several pretty dynamic sectors. We're going to break down everything from their latest financials to the broader market risks and those critical potential catalysts. It's a real tightrope walk for Tilray, balancing opportunity and challenge.
Okay, let's unpack this then. Our sources give us a pretty comprehensive look at Tilray brands, touching on fundamentals, valuation, technicals, sentiment, and yeah, those future catalysts. So to set the stage, the overall rating indicated for Tilray brands is 5.5 out of 10. That's right, smack in the middle, isn't it? What does that tell us right off the bat?
Yeah, that 5.5 rating is incredibly telling. It really reflects a company that's made some significant strides operationally. Improvements in adjusted EBITDA, expanding internationally. Plus, they've got really strong margin expansion and a solid cash position. They've even repaid about $100 million of debt, which is a good sign for the balance sheet. But, and this is the crucial counterpoint, they remained unprofitable on a GAAP basis. That's generally accepted accounting principles, the sort of official measure. And they actually missed their quarterly revenue expectations.
Oof.
So it's a very mixed bag. It just highlights how volatile and, frankly, challenging their sector really is.
That GAT, unprofitability versus adjusted EBITDA, that's a really crucial distinction for investors, isn't it? I mean, for many, missing revenue and being unprofitable on a standard basis, that sounds like a significant red flag. How much weight should you really put on these adjusted figures when the core GAAP numbers are still showing a loss?
That's a fantastic question. It really gets to the heart of valuing a company like Tilray right now. Adjusted EBITDA, in their case, it strips out certain non-cash expenses, maybe some one-time items. It gives you a cleaner look at operational cash flow before things like interest, taxes, depreciation, amortization, all that stuff. So the fact that their adjusted EBITDA in Q4 was the second highest in company history, that strongly suggests they're getting much more efficient at managing their core business operations.
Right, tightening the screws.
Exactly. Management is really focusing on the levers they can control. However, that GAAP loss reminds us they still have significant overhead, costs that aren't just going away. The company as a whole isn't consistently generating a true profit yet. So it's a balance, right? Celebrating the operational wins while acknowledging the bigger picture of sustained profitability is still down the road.
Okay, let's get into the nitty-gritty of their recent performance. Fiscal year 2025, what did the specific numbers tell us?
Right. For fiscal 2025, Tilray Brands reported net revenue of $821 million. Or $834 million on a constant currency basis. Their Q4 revenue was $224.5 million, which, as we said, missed consensus. But here's an interesting detail. About $35 million of that miss was apparently due to strategic decisions by management. Things like pruning lower-margin businesses, exiting certain markets.
Oh, okay. So not just a stumble.
Potentially not just a stumble, yeah. While a miss is a miss, it wasn't necessarily a sign of weakening demand everywhere, more like a deliberate move towards higher profitability. And that loops back to their adjusted EBITDA in Q4, which, like we said, was the second highest ever, signaling that focus on operational efficiency.
That's a fascinating nuance, that the revenue miss might have been partly strategic. So how did these numbers translate into their bottom line, profitability?
Where their Q4 FY25 earnings per share, EPS, actually beat consensus. Came in at $0.02 against an expectation of negative $0.03.
That's a positive surprise.
Definitely a positive surprise. However, connecting this to the bigger picture, their trailing EPS earnings per share over the last 12 months is still negative, deeply negative actually, and negative $2.31. Now, consensus does project those losses to narrow significantly next year, from maybe negative 20 cents down to negative 10 cents per share. So that indicates a potential path towards profitability, but it's still a path, not the destination, especially on that GAAP basis.
You mentioned a strong balance sheet earlier, lots of cash. How does that factor into their overall financial health, especially when we're talking about a company still on that path to profitability?
Absolutely crucial, yeah. With $256 million in cash and marketable securities, and that $100 million in debt repaid, Their balance sheet looks pretty robust. This gives them strong near-term liquidity, a cushion, basically, to invest in growth, weather market turbulence, without immediately needing to raise more capital, hopefully. Management guided for fiscal 2026 adjusted EBITDA between $62 million and $72 million, again, showing that clear focus on profitability. Now, this raises an important question for investors, though. While adjusted EBITDA looks promising, the press release didn't give free cash flow details.
Okay.
You should definitely monitor cash generation against their working capital and capital expenditure needs because, EBITDA shows operational strength, but free cash flow tells you if that strength is turning into actual cash.
Right. Cash they can use.
Exactly. Cash to reinvest, pay down more debt, or maybe eventually return to shareholders.
So it's about making money, but also about keeping money. Given the market they're in, particularly cannabis, what about their competitive position? They seem to be more than just a cannabis company now.
Exactly right. Tilray strategically positions itself as a diversified consumer packaged goods platform, spanning cannabis, beverages, wellness products. This diversification is a key strength. It helps buffer the cyclicality and regulatory headwinds you see in pure cannabis plays. For instance, they hold a leading share in Canadian cannabis by revenue, and their international cannabis sales really expanding. Grew 71% year over year in Q4, 19% for the full year. And what's really impressive is their global cannabis gross margin. It expanded by about 700 basis points year over year.
Wow, 700 basis points.
Yeah, that's a robust 7 percentage point increase, a strong signal of improving unit economics. Basically, they're getting more efficient at turning raw cannabis into profitable sales.
Wow, 7 percentage points in margin expansion. That's a serious jump. Suggests they're really tightening things up on the cost side. What specifically do you think is driving that kind of gain in such a competitive market?
It's likely a mix of things. Part of it could be those strategic decisions we talked about, getting rid of lower margin assets. It also suggests maybe better supply chain management, perhaps negotiating better prices, or streamlining production. And as they scale internationally, you get potential economies of scale kicking in, lowering per unit costs. Plus, their beverage segment brought in $241 million, up 19% year over year. Wellness was $60 million, up 9%. So this diversified revenue stream acts as a buffer, right? Combined with that operational focus, it's letting them find those margin improvements. However, despite their breadth and international reach, the industry still faces huge structural challenges. Core cannabis pricing pressure, that's global, and ever-changing regulations.
It's like playing chess on a shifting board.
Exactly. That's a good way to put it.
Okay, we've got a detailed picture of operations and financial health. But the big question for any investor is, what's it worth? Valuing a company like Tilray, still navigating profitability in this dynamic sector, that presents unique challenges, doesn't it? How do we even start?
It's definitely not straightforward because Tilray is still loss-making on a trailing basis. That negative $2.31 EPS, traditional price-to-earnings PE ratios aren't meaningful. They're unprofitable, so there's no E. Investors in the cannabis sector often have to look at alternatives like price-to-sales, PS, or price-to-book, PB. PS compares market value to total revenue, gives you a sense of how much investors pay for each dollar of sales. PD looks at market value versus the book value of assets. With fiscal 2025 revenue of $821 million, the PS ratio depends heavily on its current market cap, which, as you know, can swing wildly.
So it's more about revenue generation relative to market value, not actual profits right now. How does that stack up against others in the space?
Precisely. Given the ongoing losses, Tillray often trades with a discount or a premium, depending purely on market sentiment, especially around potential U.S. legalization news or how well its beverage growth is perceived. Comparing its PS to other Canadian licensed producer averages can help contextualize the risk and opportunity, especially given its diversification. The projected narrowing of losses for next year could potentially compress their forward enterprise value to revenue multiple as EBITDA improves. It's like investors betting on that future path.
A bet on the future, basically.
Pretty much. But there's still a significant gap to consistent GAAP profitability. That's the gold standard investors eventually want to see.
What about more complex models like a discounted cash flow, DCF? You hear about those being the most precise, but I imagine they're incredibly difficult for a company like this one.
Yeah, DCF tries to estimate value based on projected future free cash flows discounted back to today. While often seen as precise for Tillray, a DCF would be highly sensitive to assumptions. Assumptions about U.S. cannabis regulations, notoriously unpredictable. Assumptions about whether their gross margins hold up, about the pace of beverage growth. Any slight change in those inputs could give you wildly different valuations. It's very fragile. Management's fiscal 2026 adjusted EBITDA guide $62 to $72 million. That gives a near-term anchor for maybe a relative enterprise value to EBITDA framework. But again, no consistent GAAP profit, unknown free cash flow trajectory. It really limits the precision of a DCF. Improving EBITDA and international growth can justify a higher multiple compared to other challenged licensed producers, sure. But consistent execution on margins and actual cash flow is the gating factor for really favorable long-term valuation.
Okay, so beyond the balance sheet and what it should be worth, what's the market actually doing with the stock? What does the recent price action tell us?
Well, the stock was indicated up roughly 19% intraday, around $0.78 back on August 11, 2025. That followed a strong earnings beat in late July. This really highlights its high beta, meaning the stock tends to move with exaggerated swings compared to the broader market.
Big swings.
Yeah, big swings. When the market hiccups, Tilray often takes a much bigger dive, and vice versa. It's definitely an event-driven stock. Traders should look for recent swing lows as potential support levels where buyers might step in, and look at prior post-earnings spikes as resistance where sellers might show up.
Are there key price points to watch? Those psychological levels, do they really matter, or is it just noise for such a volatile stock?
It's fascinating how those round numbers become almost self-fulfilling, isn't it? Like everyone subconsciously agrees on a price point. For a low-price stock like Tilray, trading below $1, levels like $0.75, Tilray Assassin 85, and the big one, $1, they often act as near-term pivots. Traders are human, right? They tend to round. So these levels can become magnetic. Significant buying or selling pressure often gathers there.
Psychology plays a big role.
Especially in highly traded volatile names like this. Absolutely.
And what about technical indicators or broader trends? What should traders be looking at here with all this volatility?
Well, the post-earnings momentum suggests a short-term bullish bias. For now, however, the broader trend has been incredibly volatile. Frequent mean reversions, meaning the stock often snaps back to its average price after big moves, up or down. That's common for cannabis stocks. Feels like riding a roller coaster sometimes. Momentum indicators like RSI or MPD, which tells us if a stock is overbought or oversold, or if its trend is gaining or losing steam, they likely cycle very quickly around events. So strong risk controls are absolutely essential here. Expect wide intraday ranges, potential gaps, especially around earnings or big regulatory news.
Let's pivot to recent news and sentiment. That July 28th earnings report was mixed, as we said. What parts really moved the needle for sentiment and why?
You're right, classic mixed bag. The report showed that EPS beat 0.75 cents versus consensus, improving margins, robust international growth. Those were the positives that get investors excited about the path to profit. However, revenue missed consensus, came in around $224.5 million versus expectations closer to $250.4 million. Despite that revenue shortfall, the profitability signal seemed to boost sentiment more. Because in this sector, I think signs of actual business health, like better margins or EBITDA, often trump top-line numbers if the path to the bottom line looks clear.
Interesting. Bottom line focus.
Yeah, seems that way lately for Tilray.
Any upcoming news or events we should watch for, and how does social media usually react with this stock?
The next earnings report is expected early October, before the market opens. That'll likely be the next major catalyst for sentiment. Investors will be watching closely to see if that fiscal 2026 EBITDA trajectory stays on track. There weren't specific insider transaction details in the releases we looked at, which can sometimes give clues. But social media sentiment for Tilray, it tends to be extremely headline-driven, improves dramatically on earnings beats, any legalization chatter, deteriorates just as fast on revenue misses or broader sector downturns.
Almost a proxy for the cannabis mood.
Yeah, that's a fair way to put it.
Looking ahead then, what are the immediate drivers that could move this stock? And what's the bigger picture for the long term? Short-term catalysts first.
Short term, that early October earnings report is key. Investors will scrutinize sustained adjusted EBITDA and, hopefully, get some cash trend data. Any updates on international cannabis expansion or significant growth in their beverage segment, those could also influence near-term multiples. Beyond that, any sector-wide regulatory headlines, positive or negative, can cause really outsized moves in the stock, often disproportionate to the actual fundamentals.
Because the sector lives and dies by regulation.
Pretty much.
And for the long-term investor, what's the big picture catalyst? The U.S. regulatory changes. Always the elephant in the room, right? How much hinges on that? What else is on the long-term checklist?
You hit the nail on the head. Long-term, the biggest elephant is potential U.S. regulatory changes. Things like federal rescheduling of cannabis, which could ease restrictions, passage of safe banking legislation, opening up traditional financial services. State-level expansions are also key. These could open massive new markets, dramatically improve capital access. It would be a game changer for the whole industry, including Tilray. Beyond that, continued growth in their diversified beverage and wellness segments is important. That buffer against cannabis pricing pressure is crucial. And finally, any strategic M&A or portfolio optimization efforts could help them scale margins and distribution internationally.
Okay, but no investment is risk-free. What are the key stock-specific risks for Tilray, and then the broader market risks?
Stock-specific. Well, the persistent Jap losses. That negative $2.31 trailing EPS. And the uncertainty about when they'll reach sustained profitability and consistent free cash flow, that's a big risk. There's also considerable execution risk. Integrating and scaling diverse segments, cannabis, beverage, wellness, while also trying to expand margins across all of them, that's a lot of plates to keep spinning.
Juggling act.
Definitely. And lastly, there's a risk of potential shareholder dilution. If the company needs to raise more capital before hitting consistent free cash flow, that could happen. Issuing more stock dilutes existing shareholders.
And beyond Tilray's direct control, those sector-wide storms.
The cannabis regulatory uncertainty across different geographies is massive. Changes in laws affect demand, pricing, compliance costs, capital access, sometimes overnight. Competitive pressures, price compression, especially in Canada and internationally, could easily eat away at any volume growth, wiping out profitability gains. And as we discussed, high volatility, sentiment-driven trading, sharp drawdowns around news events, sometimes totally disconnected from the company's actual performance.
Not for the faint of heart.
Definitely not.
Okay, let's bring it all together. Pulled apart the data, the charts, the catalysts. What's our overall take on Tilray Brands? Is it a good time to buy now?
Well, that 5.5 out of 10 rating really captures the nuance, I think. While Tilray has shown commendable progress, adjusted EBITDA, international growth, margin expansion, adequate liquidity, they remain unprofitable on a GAAP basis, and they missed revenue expectations last quarter. Plus, they operate in a highly volatile, regulation-dependent sector, lots of external risk. The risk-reward profile would dramatically improve if that fiscal 2026 EBITDA guidance is consistently met or raised, and crucially, if cash generation strengthens. Otherwise, it primarily remains more of a tactical trade, riding short-term waves rather than a long-term hold based on fundamental value right now.
So who is this stock really for then? Clearly not everyone.
It's exactly.
Yeah.
Better suited for short-term trading. For those who can navigate high volatility, event-driven swings. Selective long-term positioning. Only really advisable for investors who are extremely comfortable with significant regulatory and execution risk, and who have a truly long-term horizon, willing to wait patiently for those potential U.S. regulatory game changers.
For those traders listening, any practical entry and exit points to keep in mind, given its erratic nature?
Yeah, for entries, maybe consider staged approaches. On pullbacks towards recent support levels, perhaps below $0.80, always with tight risk controls, don't go all in at once. Momentum entries, possible on sustained breakouts above 90 cents, maybe $1, but they need confirmation with very strong volume. Otherwise, it could easily be a head fake.
A bull trap.
Could be. For trading, a stop loss around 8% to 12% below your entry is strongly suggested. Adjusted to recent swing lows to account for that volatility. Taking profits. Consider scaling out into strength. Near prior reaction highs, those psychological levels like $0.90, $1.15, and always reassess as new earnings or sector headlines emerge. Think of it like a carefully planned expedition into unpredictable terrain.
What a comprehensive breakdown. It's clear there are so many moving parts with Tilray Brands. Requires a very active and informative approach for anyone involved.
Absolutely. The cannabis sector, with its unique regulatory landscape, evolving market dynamics, it continually presents complex challenges and, yes, unique opportunities. Never a simple story.
Indeed. And for you, our listener, the challenge isn't just understanding the numbers. It's also about truly understanding your own risk tolerance, your own investment horizon within such a dynamic industry.
Which raises, I think, an important final question to ponder. In a market driven so much by both fundamental progress and pure headline-driven sentiment, how much weight should you give to short-term momentum versus that long, often very unpredictable path to profitability? Definitely something to think about as you consider your next move.